Welcome to the latest financial update.
Hey everyone, welcome to Legacy Income Report, your trusted source for retirement news, Social Security updates, tax strategies, and wealth preservation. If you're looking to protect your retirement and stay informed, you're in the right place. Let's get started.
Thanks for having me. We really do have some deeply impactful financial mechanics to walk through today that, could radically change how you manage your money.
We really do. And I want to start by throwing a rather unsettling reality your way. There are thousands of retirees right now, people who spent, 40 years diligently saving and investing, who are just paying dramatically more in taxes than they legally owe.
Yeah, it's heartbreaking. And the thing is, they aren't making arithmetic errors on their 1040s, right? They aren't breaking any IRS rules.
Exactly. They're simply bleeding capital because they're missing out on hidden tax strategies.
It's a massive, basically invisible leak in so many retirement plans. So the goal of our deep dive today is to really illuminate the specific mechanisms behind these missed opportunities.
Right. We're going to look at the math, explain exactly how the rules work, and lay out an action plan so you can structure your withdrawals and expenses to keep your own capital where it belongs.
Exactly. And to really get into the mechanics of this, we first need to, dismantle a pretty pervasive myth.
Oh, the myth that your taxes just vanish. Right. There's this deeply ingrained assumption that once you stop collecting a W-2 paycheck, your tax burden essentially evaporates.
Right. But the reality is that the IRS doesn't retire just because you did. Taxes do not disappear, they transform.
Transform how? I mean, for most people, their working years are pretty straightforward, yeah.
Yeah, exactly. In your working years, your tax situation is relatively simple. You're taxed on your salary. But in retirement, your income is cobbled together from Social Security, traditional IRAs, 401ks, pensions, taxable brokerage accounts.
And every single one of those buckets has a completely different set of tax rules.
Exactly. Which brings us to the single largest blind spot we see in retirement planning.
Yeah, and this is what many retirees just don't realize. We're talking about the hidden tax benefits associated with medical expenses.
Right.
And to really illustrate this, I want to look at a hypothetical retiree. Let's call her Susan. So Susan is 68. She lives on Social Security and takes regular distributions from her traditional IRA.
Okay. Pretty standard setup.
Very standard. And over the course of the year, she pays her Medicare Part B and Part D premiums, buys prescriptions, sees a couple of specialists, and gets some expensive dental work done.
Yeah, which is a very normal year for a 68-year-old. But the trap here is how Susan categorizes those expenses in her mind.
Right, because healthcare is just a necessity.
Exactly. She views it purely as an unavoidable personal cost.
Right.
She doesn't track these bills through a financial planning lens, and as a result, she misses out on a massive tax deduction.
Now, let me push back on this a bit because I know exactly what the listener's thinking right now. The IRS rule states that you can only deduct medical expenses that exceed 7.5% of your adjusted gross income, or your AGI.
Yes, that's the rule.
So if my AGI is, say, $80,000, 7.5% is $6,000. It sounds almost impossible to hit that threshold just on copays and prescriptions unless I have some kind of catastrophic medical emergency.
And that right there is the exact misconception that stops people from tracking their expenses. You are right about the 7.5% threshold. But what most seniors fail to calculate is that Medicare premiums count toward that threshold.
Wait, really? The premiums deducted directly from your Social Security check?
Yes, they absolutely do.
Yeah.
Your Part B premiums, your Part D prescription drug coverage premiums, and your Medicare Advantage or Medigap supplemental premiums, those are all deductible medical expenses.
Wow, so they actually count toward that 7.5%.
They do. When you add up 12 months of those premiums, plus your out-of-pocket dental work, vision care, hearing aids, and prescriptions, you are suddenly much closer to that $6,000 hurdle than you think.
But if you just throw away the pharmacy receipts, you have no way to prove you crossed the line.
Exactly. You're just flying blind.
Okay, but even knowing that, I have to challenge this with what I think is the biggest hurdle of all. For a married couple over 65, the standard deduction is approaching $30,000.
Right. It's high.
So if my total itemized deductions don't beat the standard deduction, tracking every single bottle of aspirin just feels like a massive waste of time.
That is a very logical objection. And it leads us directly to a strategy called bunching. You're right that in a vacuum, a single year of medical expenses might not beat your standard deduction.
Okay, so what do you do?
Well, what if you take control of the timeline? Let's say you know you need a knee replacement, and you also know you need dental implants.
Right.
If you spread those across 2 different tax years, you might fall short of the standard deduction both years. getting zero tax benefit.
Ah, I see. But if I schedule the dental implants for December and the knee replacement for January...
No, wait, you want them in the same tax year.
Oh, the same year. Got it.
Yeah, if you schedule both for the same calendar year, you combine those massive expenses. Suddenly, you blow right past your standard deduction. You itemize for that one specific year to capture a huge tax break.
And then you simply revert back to taking the standard deduction the following year.
Precisely. It's incredibly efficient.
That is brilliant. You're basically strategically shifting the dates of your medical care to engineer a tax deduction.
Exactly. But, this requires you to know exactly where you stand, which means you really have to be tracking the numbers.
Because if you don't track it, you don't know if you're close to the threshold.
Right. And tracking those numbers is critical because of a hidden penalty called IRMAA, which is the Income-Related Monthly Adjustment Amount.
Let's define that, because IRMAA is something that catches so many retirees completely off guard.
Oh, it really does. So IRMAA is a surcharge added to your Medicare Part B and Part D premiums if your income crosses a certain threshold.
Right.
The government looks at your modified adjusted gross income, or MGI, from 2 years prior. If you cross their limit, even by a single dollar, you're pushed into a higher premium bracket for the entire year.
Oh, wow. So it's basically a cliff penalty.
It is a steep cliff, and the reason this connects to our medical expense discussion is because of inflation.
Right. The real issue for everyone right now.
Exactly. When costs go up at the grocery store or the gas pump, retirees naturally pull more money out of their traditional IRAs to cover their rising bills. But pulling more money out increases your MGI.
So by taking out extra money to pay for inflation, you accidentally triggered the IRMAA cliff, which makes your Medicare premiums spike.
Yep.
Meaning you now need to pull out even more money to cover the higher premiums. It's just a vicious cycle.
Exactly. It's a total trap. This is why utilizing tax deductions like medical expenses is not just about saving a few dollars in April. It actually acts as an inflation shield.
Because lowering your taxable income keeps you safely beneath those IRMAA cliffs.
Exactly. It protects your cash flow.
That perfectly transitions us into the other side of the equation. We've talked about how you handle your expenses, but we also need to look at how you handle your distributions, because the mechanics of moving your money can be just as dangerous.
Oh, absolutely.
Let's talk about charitable giving. A lot of retirees are incredibly generous. They write checks to their church or local food bank every month.
And sadly, writing a check from a personal bank account is the absolute least efficient way to give to charity in retirement.
Explain why. Because if I'm taking the standard deduction anyway, doesn't my charitable giving effectively give me zero tax benefit?
If you give cash, yes, you get zero tax benefit if you take the standard deduction. But the tax code offers a mechanism called a qualified charitable distribution, or a QCD.
Okay, how does that work?
Once you reach age 70 and a half, the IRS allows you to transfer money directly from your traditional IRA to an eligible charity.
Directly from the IRA to the charity, so it never touches my checking account.
That is the key right there. Because the money goes straight to the charity, it is never added to your adjusted gross income.
Oh, wow.
Yeah, this is incredibly powerful for two reasons. First, it lowers your MGI, which helps keep you away from those IRMAA Medicare cliffs we just discussed.
Right, the inflation shield again. And second,
it satisfies your required minimum distributions. At age 73, the IRS forces you to start taking money out of your traditional retirement accounts. These are your RMDs, and they tax you on those withdrawals.
right, you have no choice but to take it.
Exactly.
Yeah.
But if you use a QCD, you fulfill that government mandate without adding a single penny to your taxable income. You get to support your favorite cause, and the IRS gets nothing.
That is a staggering difference in outcomes just based on the plumbing of how you route the money. I mean, you still gave the exact same $5,000 to your church.
Yep.
But because you routed it through a QCD instead of your checking account, you avoided income tax and potentially saved yourself from a Medicare surcharge.
It all comes down to the mechanics. And speaking of the plumbing of your finances, we really have to address the most destructive mistake retirees make.
Ad hoc lump sum withdrawals.
Yes. The absolute worst thing you can do.
This is huge. Let's look at a scenario with two hypothetical retirees, John and David. On paper, their financial pictures are identical. They both receive the same Social Security benefits, and they both have $500,000 in a traditional 401k.
So their starting lines are exactly the same.
Right. But John sits down in January, calculates his exact income needs for the year, and structures monthly withdrawals that keep him securely in the 12% tax bracket.
Very smart.
But David treats his 401k like a checking account. He takes out a little here and there. Then in July, David decides he wants to buy a $30,000 RV, so he logs into his account and pulls out a $30,000 lump sum.
And David has just triggered a catastrophic chain reaction of taxation. We need to explain exactly what happened here using the concept of tax brackets.
Right, because tax brackets aren't just a flat rate across the board.
Exactly. Think of tax brackets like a series of buckets. The first bucket holds your income taxed at 10%.
Right.
Once that bucket is full, the income spills over into the next bucket, which is taxed at 12%.
Okay, making sense.
And once the 12% bucket is full, the water spills into the 22% bucket.
So when David took out that $30,000 all at once for the RV, he effectively dumped a massive pitcher of water into his income stream.
Exactly. He instantly overflowed his 12% bucket and pushed a large chunk of that withdrawal into the 22% bucket.
Ouch.
If he had spread that purchase across 2 tax years, say, pulling $15,000 in December and $15,000 in January, he might have kept all of that money in the lower bucket.
But the higher tax bracket isn't even the worst part of David's mistake, is it?
No, it isn't. The real damage is a mechanism known as the Social Security tax torpedo.
Oh, man. Walk us through the mechanics of the torpedo, because this is the exact moment where so many seniors realize they've been overpaying.
Yeah, it's brutal. So, to determine if your Social Security benefits are taxable, the IRS calculates something called provisional income. Your provisional income is your adjusted gross income plus any non-taxable interest, plus 1/2 of your Social Security benefits.
Okay, so it's AGI plus half of Social Security.
Right. If that combined number is below a certain threshold, which is $32,000 for a married couple, your Social Security is entirely tax-free.
Which is great.
But as your provisional income rises above that threshold, up to 85% of your Social Security benefits suddenly become subject to federal income tax.
Wow. So let's look at David's RV purchase through that lens. By pulling that $30,000 lump sum out of his traditional 401k, he drastically increased his adjusted gross income for the year.
Which means he drastically increased his provisional income. Before the withdrawal, David's Social Security was completely tax-free. But that single $30,000 withdrawal acted as a trigger. It pushed his provisional income over the threshold. So not only did David pay 22% income tax on the withdrawal itself, but the IRS also stepped in and taxed 85% of his previously tax-free Social Security benefits.
The torpedo. He essentially paid taxes twice on the exact same financial decision. He paid tax on the 401k money, and that money caused his Social Security to be taxed.
That is exactly why we call it the torpedo. It sinks your capital from 2 completely different directions.
That's terrifying.
And it highlights why tax planning in retirement is actually more critical than investment performance. You could spend 30 years agonizing over whether a mutual fund is yielding 6% or 7%.
Right.
But if you lose 20% of your wealth on the back end because you don't understand provisional income or tax brackets, you've completely defeated your own efforts.
This all really boils down to awareness. The difference between John, who optimized his income, and David, who got hit by the torpedo, wasn't luck.
No, not at all.
It wasn't that John had a crystal ball for the stock market. John simply understood the rules of decumulation. So for the listener who wants to operate like John, what is the concrete action plan here?
Well, the very first step is to look backwards, to move forwards. Pull out your tax return from last year, your Form 1040, sit down and look at the actual numbers.
What should they be looking for specifically?
What was your adjusted gross income? What was your standard deduction? Did you pay any taxes on your Social Security? You cannot optimize a strategy if you do not know your baseline.
Right. You have to know where the water level is in your buckets before you start pouring more in.
Precisely. Step 2 is to establish a centralized tracking system for this current year. And the mechanism really does not matter. It can be an app, a spreadsheet, or literally a manila folder on your kitchen counter.
Just something to keep it all together.
Yeah. Whenever you pay a Medicare premium, whenever you buy a prescription, whenever you get dental work done, the documentation goes into that system.
So what are the biggest mistakes people make when they try to implement this? Because it sounds easy in theory, but clearly people stumble.
Oh, they definitely do. The most common pitfall is treating this like an April problem. If you wait until tax season to try and reconstruct a year's worth of medical expenses and charitable giving, you will fail.
You'll just give up.
Exactly. Documents will be lost, you'll get frustrated, and you will just take the standard deduction out of sheer exhaustion. It has to be a year-round, ongoing habit.
Another danger I see frequently is what we might call water cooler advice. You know, taking financial cues from your neighbors or your friends.
Oh, that is a critical error. In
Yeah.
retirement, every single person has a completely unique financial fingerprint.
Right.
Your neighbor might have a military pension and a Roth IRA, while you are relying entirely on Social Security and a traditional 401k.
Yeah.
The exact strategy that saves your neighbor thousands of dollars could actually trigger the Social Security tax torpedo for you.
Wow. Yeah, you cannot just borrow someone else's tax strategy.
Never. Which points directly to the value of professional guidance. The transition from accumulating wealth to decumulating wealth requires a completely different set of skills.
It really does.
You don't just need someone to pick stocks anymore. You need a professional who specializes in tax-efficient withdrawal strategies. You bring the track data, and they provide the strategy.
And the goal isn't for you to memorize the IRS tax code. You don't need to become a CPA. The goal is to understand the mechanics well enough to ask the right questions and to recognize when a seemingly simple decision like buying an RV or giving to a charity might have massive invisible consequences.
Exactly. You just want to be informed enough to stop the leaks.
So, let's distill all of this down into our core takeaways from the deep dive today. First, healthcare expenses are a severely underutilized tax shield. Remember that Medicare premiums count toward your 7.5% threshold, and consider the strategy of bunching your procedures into a single year to hurdle your standard deduction.
Yep. Second, how you route your money completely changes how it is taxed. Utilizing qualified charitable distributions allows you to give generously, satisfy your required minimum distributions, and keep your adjusted gross income low.
And third, lump sum withdrawals are incredibly dangerous. Pulling large amounts of money from traditional retirement accounts can overflow your tax brackets, trigger Medicare, IRMAA surcharges, and detonate the Social Security tax torpedo. Always look at the ripple effects of your distributions.
Yeah, you really have to. And I actually want to leave you with a final thought to really mull over. It's something we haven't touched on yet, but it's looming on the horizon.
Okay, what is it?
The tax brackets and standard deductions we are operating under right now are not permanent. Many of the current tax provisions are scheduled to sunset in the near future.
Oh, right.
This means the water levels in those tax buckets are going to change. The rules of the game are shifting while you are actively playing it. So ask yourself, if your strategy is leaking capital under today's rules, how much more vulnerable will your retirement be when the brackets inevitably tighten?
That is an incredibly important point to consider. You spent your entire life building the fortress. Now you have to proactively defend it. Take the time to review your 1040, organize your records, and start looking at your withdrawals strategically. If you found this deep dive helpful, be sure to like this video, subscribe to Legacy Income Report, and turn on notifications so you never miss important updates that could affect your retirement and financial future. Thank you for watching, and we'll see you in the next report.